What you find in studying history is that depressions are mostly debt and liquidity crises that are dealt with one way or another through easing of monetary policy, which changes over a period of time.
Ray Dalio is one of the greatest economic geniuses of all time. He is the founder of Bridgewater, one of the world's most prestigious hedge funds. He provides unique insight into the inner workings of the economy and the stock market. He recently caught my attention when he started talking about what he calls massive wealth transfers. Today, I'm going to share with you a recent speech he gave, and we'll discuss whether he's right or wrong. I ask you to watch the video to the end and share your views with us.
What you find in studying history is that depressions are mostly debt and liquidity crises that are dealt with one way or another through easing of monetary policy, which changes over a period of time. I described monetary policy 1, interest rates. Monetary policy 2, buy financial assets, print money and buy financial assets. Monetary policy 3, which we are in, is the printing of a lot of financial assets by the central bank and then buying government bonds to finance the deficit and getting money in the hands of those who wouldn't have had it through the normal financial system, essentially through that coordination. In all history, so when we go back to the 1800s and so on, there is that. And so the alleviation will happen in terms of that kind of ease. So when we think interest rates are going to hit zero and that therefore depressions last, no, they don't last. Because in one form or another, and we're seeing it here today, that they will be the printing of money. Now, the value of money may not last, or they could be depreciated. But in the end, they always will ease, and you will have then that kind of reflation movement and that kind of change. So the hitting of a zero interest rate is not a hitting of a floor on the capacity of central banks to ease. It has to be manifest in one of three things happening. If you look at the history, you've seen it happen time and time again in the same way, and it lends itself to three types of assets responding. The that's happened in March 5th, 1933. Roosevelt makes the announcement about severing the dollar from gold and depreciating it and reflating it to give the banks the money that they have to pay their depositors. The same thing happened August 15th, 1971, when Nixon got on television and said that he is severing the relationship with gold and printing money and so on. The same thing happened in November 2012 with Mario Draghi making the same kind of moves. And the same thing happened on April 9th when we had the moves by the U.S. Federal Reserve and the U.S. Congress and Treasury. Same type of movements happened in 2008 when the Treasury put together and the administration and the Congress put together the TARP program and they went to quantitative easing.
Ray Dalio paints a vivid picture of how economic crises are handled through a cycle of monetary policy adjustments. What's striking about his analysis is that although these strategies may seem like modern inventions, they've been used repeatedly for over a century. The history of severing the dollar from gold, from Roosevelt in the 1930s to Nixon in 1971, shows how policymakers consistently resort to similar tactics in times of economic stress. The big question for us today is whether these tools, printing money and lowering interest rates, are enough to handle the massive debt and liquidity challenges we face now. But let's dig deeper into this. If we look at data from 2008, during the global financial crisis, the Federal Reserve's balance sheet skyrocketed due to quantitative easing. They injected trillions into the economy by buying financial assets, which stabilized markets, but also led to a decade of low interest rates and inflated asset prices. Fast forward to today, we are seeing similar actions, but on an even larger scale. The Fed's balance sheet has more than doubled since 2020, and while it may prevent immediate financial collapse, it's creating long-term risks, especially inflation. Take real estate as a prime example. The median home price in the U.S. has soared by more than 20% since 2020. Why? It's not just demand, it's cheap money. With interest rates at record lows, borrowing has become incredibly affordable, leading to surging asset prices. However, this also means that the purchasing power of the average person is being eroded. Housing affordability is becoming a serious issue for many, especially first-time homebuyers.
So what you're seeing right now is that reflation becoming manifest in the money that is being purchased by the Federal Reserve and government, then going into assets that are equity assets, into credit assets, and so on. And that's the manifestation. Or you could see it in gold, or you could see it in the depreciation. One doesn't necessarily know at the time which is going to happen. So in 1971, when that happened, there was a big decline in real stock prices because inflation accelerated. But you do know that that combination of reflation assets will happen in a way that's very similar to the cutting of interest rates when they hit zero. I really believe that in this environment, most investors will think safe is cash, and that's tragic. So you can see that one has to think differently from one's habits. When one thinks cash is not a safe investment, it's a risky investment, that stocks and bonds are not the same as they were in the past. One has to think of the storehold of wealth concept rather than just equity returns. One has to think about balancing differently. All of these things that I'm bringing up are not commonly thought about. They're not part of the common experience of investing over the past many years.
Dalio's point about cash being a risky investment is a powerful reminder that traditional thinking can lead us astray in uncertain times. For decades, cash has been viewed as the safest haven during volatile markets. But in an environment of aggressive money printing and rising inflation, holding cash could be one of the riskiest moves an investor can make. Why? Because inflation erodes the purchasing power of cash. Let's put that into perspective. Here's a graph showing the inflation-adjusted value of $100 over the last 50 years. In 1970, $100 had significantly more purchasing power than it does today, simply because inflation has steadily eroded its value. Now imagine if you held your savings in cash during periods of high inflation. Over time, you would have lost significant wealth. In contrast, assets like gold, real estate, or even equities have historically fared much better during inflationary periods. Gold, for instance, tends to rise as the value of fiat currencies fall. Similarly, real estate provides a tangible asset that holds its value as prices rise. The key takeaway from Dalio's insights is this: in times of uncertainty, we need to rethink what constitutes a safe investment.
In order to understand the lessons of history and even what's more likely to take place, one has got to go back to periods that were analogous to this and to study those periods. And when we did that over the last 500 years, you could see that you don't know if you're going to see the depreciation of the value of money and the storehold of wealth. So all of a sudden that changes what you define as risk. You used to think cash as a riskless asset. Cash can be the most risky asset as it depreciates in value. And then you start to think about different asset classes and different locations. So that's what we're doing. When we think of what is the diversified portfolio for an easing that happens at that time, that's kind of a reflation portfolio. And how do you measure that in relationship to other things? Because I think the one thing that we can be confident is that the Federal Reserve and other central banks are not going to let an implosion happen without printing a lot of money. We know where interest rates are. You know that if you take a 10-year bond, you know what your return is going to be on that 10-year bond. And if you then do calculations of what is the expected returns of other asset classes, start off as you deal with each of those companies that are borrowing, and you look at what their interest rate is, and then you look at their equity expected return relative to their interest rate based on the present value of the discounted cash flows, that all asset classes, and that includes private equity, it includes venture capital and so on, have very low expected returns, meaning that if you were to just hold them over the next 10 years, they're all going to have not nearly enough return, and they're going to be low.
Dalio's study of history reminds us that understanding the past is crucial for navigating the future. If we examine periods of economic turmoil similar to today, like the 1930s or the 1970s, we see that when inflation rises and cash loses value, diversified portfolios become essential. That's why Dalio emphasizes diversification across asset classes and geographies. You can't afford to put all your eggs in one basket. Imagine a portfolio heavily invested in one asset class, say bonds, during a period of rising inflation. As inflation eats into your returns, that portfolio could suffer significant losses. On the other hand, a well-diversified portfolio spanning equities, commodities, real estate, and perhaps even cryptocurrencies can weather the storm. Let's take a look at a portfolio diversification example from 2008. Investors who held a mix of stocks, bonds, and commodities saw a much quicker recovery post-crisis compared to those who only held equities. Diversification not only reduces risk, but it also positions investors to benefit from different market cycles.
When I look at it, for example, what we're seeing is reflation. We're seeing the central banks printing money and buying assets. And I do believe that they're going to continue to do that. Then the question is, does that become manifest in a way where it drives stock prices up? Does it drive the value of money down? Does it drive gold prices up? So what I've done just over the last maybe year and a half was to go back through all history. You know, you're aware of the 500-year study of all of these particular cases, and to see literally what that set of choices is in all of that range of choices. What you will get is easiness, but the lessons of what will happen largely existed prior to 1945 when we began our monetary system. What I mean is that we've been living in an environment of ideal conditions, which began in 1945 with the formation of the new monetary system and the dollar-based monetary system and the restructuring. And that's been a great, great environment. And we have learned certain habits from that environment. For most investors, you have to think about real returns, but not for all investors, because in some cases they've incurred a fixed liability. In any case, I think the big thing is that almost no investors has enough money relative to their needs. It may affect the time horizon, but if you looked at the richest investors, generally speaking, and you looked at what are their revenues, what are their expenses, and what is their saving, every individual, every company, every country has to go through that exercise. And when you look at that exercise, can you spend on your liabilities or pay out that amount of money based on the income that's coming in or the way you're going to have to tap that savings pool? You can see all around you those that are going to not be able to make it, not be able to come close in the period that we have. You have to think, what does that mean? That is going to mean that those will not default. You cannot tell most of the people that they won't get their money. That is going to mean that a lot of money is going to have to be printed because the obligation is to print that amount of money to fill those liabilities. And so that's the situation that we and most of the world are in.
Dalio is pointing out something critical. Many governments and companies simply won't be able to meet their long-term liabilities without further money printing. And that brings us to a challenging reality. The world is undergoing a massive shift in the way wealth is distributed. Historically, we've lived in a relatively stable economic system since the end of World War II, but the cracks are starting to show. For today's investors, the key takeaway is to focus on diversification, especially in competitive countries and markets that can navigate the upcoming changes. Holding a mix of asset classes across geographies is essential for weathering the potential storms on the horizon. It's not just about chasing returns anymore. It's about preserving wealth in a rapidly changing economic landscape. So there you have it. Make sure to hit that subscribe button because it is my goal to make you a better investor by studying the world's greatest investors. Talk to you again soon.